Alphabet just reported fourth quarter earnings, and once again the market is asking the same question. Is Google still one of the strongest long-term tech stocks, or are cracks starting to form beneath the surface? In this video, I'm breaking down Alphabet's most recent earnings report. Take a look at the charts, and I'll give a one-year price target for the stock. Let's generate alpha. Here are the headline results. Alphabet reported $113.8 billion in revenue, up about 18% year over year. That easily beat analyst expectations. Earnings per share came in at $2.82, also marking a solid earnings beat. Net income climbed to around $34.5 billion, a 30% increase compared to last year's quarter. Operating income was roughly $35.9 billion, with margins holding up around 31%, despite heavy investment. For the full 2025 year, Alphabet's total revenue topped $400 billion for the first time ever, which is a huge achievement. Digging deeper into the business lines, search revenue was up about 17% year over year. Alphabet highlighted that its Gemini 3 AI app now has over 750 million monthly active users, and AI product integration continues to expand across search and cloud. YouTube continues to be a powerhouse, with combined ads and subscription revenue exceeding $60 billion annually, and ad growth still in double digits. Google Cloud was the standout growth engine, surging about 48% to reach $17.7 billion in quarterly revenue, a major acceleration compared to the same period last year. Now here's where things get interesting. Despite the great quarter, Alphabet shares didn't skyrocket. In fact, they moved modestly or even dipped at times, largely because of capital expenditures. The company is planning massive AI and infrastructure spending in 2026. This is a common theme amongst the biggest tech companies. Management guided to a huge $175 to $185 billion in CapEx for 2026, nearly doubling prior expectations as the company pours money into AI chip infrastructure and data centers. The CEO emphasized that AI remains central to future growth, from expanded search capabilities to enterprise cloud solutions, even if it means compressing margins in the short term. Whether you're a long-term investor or thinking about buying, this earnings report tells us that Alphabet remains a foundational tech powerhouse, but with a heavier emphasis on future AI leadership than ever before. Let's take a look at the charts. The current price is below the 50-day moving average, suggesting the short to medium-term trend is weak and momentum has been fading recently. But the price is well above the 200-day moving average, meaning the longer-term trend is still up. The stock is still trading above its long-run baseline. The 50-day is also above the 200-day, which is generally consistent with a bullish longer-term structure, even if the stock is currently in a correction. The relative strength index is below 30, which is commonly interpreted as oversold momentum. It's not a guarantee of a bottom, but it often signals selling pressure has been heavy. Right now, Google looks like it's in a pullback within a longer-term uptrend. It's below the 50-day, above the 200-day, with an RSI near oversold, suggesting this could be an opportunity for long-term investors. Here are three of the biggest risks currently facing Alphabet's stock, factors that could materially impact its share price and investor returns. Disruption to its core search business. Alphabet's dominant revenue engine, search advertising, faces a potential fundamental shift in how users find information. Generative AI and new intelligent agents, from startups and rivals, could redirect queries away from traditional search pages, reducing click-through rates and search volume, the core driver of high-margin ads. If these AI experiences don't monetize as effectively as traditional search ads, Alphabet could see slower growth in ad dollars even if engagement remains high. It affects the economics of the business model itself rather than a cyclical downturn. Regulation. Alphabet remains under intense scrutiny in multiple jurisdictions, with possible consequences that include fines and changes to its business model. Governments are targeting Google's dominance in search and ad tech. Remedies could include behavioral restrictions, outcomes that could materially reduce revenue or profitability. European regulators are investigating its AI training practices and competition issues. Potential fines and compliance costs could be significant. Heavy spending. Alphabet is spending very large amounts on data centers, AI infrastructure, and cloud expansion, which carries risks if returns don't materialize as expected. If AI monetization lags, markets could penalize the stock due to lower operating margins or slower EPS growth than priced in. This risk is about execution and returns on investment. Even a successful technology doesn't guarantee proportional profits. Bonus risk, broader market and tech cycle volatility. Although not unique to Alphabet, tech stocks, especially big AI plays, are susceptible to valuation swings and bubble fears. If AI hype fades or macro tightening resurfaces, high valuation growth stocks could see sharp corrections. Now, the big question: where could the stock go from here? Most analysts maintain a buy rating with an average price target of $348. Looking at the discounted cash flow model, the base case estimated value for the stock is about $204, and the best case is $386. As for my opinion, I am giving Alphabet a buy rating with a one-year price target of $375. Here are 3 reasons why I believe it's a buy, especially for long-term investors. Alphabet owns irreplaceable platforms: Google Search, YouTube, Android, Gmail, Google Maps. These aren't just popular products. They're daily habits for billions of people. That kind of ecosystem creates a business model that's extremely hard to disrupt. Even when advertising slows, advertisers always come back to Google because that's where user intent lives. Reason number 2. AI is a long-term growth driver, not just hype. Alphabet is deeply embedded in AI across search, YouTube recommendations, Google Cloud, and enterprise tools. While the market focuses on flashy AI headlines, Alphabet is quietly monetizing AI at scale with real users, real data, and real cash flow, and it already has the infrastructure to support it. Waymo continues to grow and expand as well. Last year, I was in San Fran and my wife and I took a Waymo just for fun to see how it works. It was a cool experience and eye-opening to see all this AI in action. Reason number 3, the valuation is still reasonable for the quality you're getting. Despite its dominance, Alphabet trades at a much more reasonable valuation compared to many big tech peers. It's currently trading at a forward price to earnings ratio of about 26. It generates massive free cash flow, has a fortress balance sheet, and continues to buy back shares, which quietly boosts long-term shareholder returns. Alphabet isn't a flashy trade, it's a compounding machine. If you're thinking long-term and want exposure to digital advertising, AI, and global tech infrastructure in one stock, Alphabet remains a very strong buy in my view. Thanks for watching. If you enjoyed this video and want more earnings recaps with one-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I currently own Alphabet shares through an ETF. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.